Ladies and gentlemen, let me be clear. This isn't a guess. This isn't a theory. This is a trap being carefully engineered right now for gold and silver investors. You're being lulled into a false sense of security by headlines, by short-term price moves, by the illusion that everything is under control. But behind the scenes, the same institutions that created the last crisis are setting the stage again, only this time they want you positioned exactly wrong. And if you don't see it coming, you won't just miss the opportunity. You'll pay for it. What you're being told about the strength of the financial system doesn't match reality. It just sounds convincing enough to keep people from asking the right questions. You hear that the economy is resilient, the currency is strong, that policymakers have everything under control, but that strength is not organic. It's manufactured. It's propped up by policy decisions that create the appearance of stability while quietly undermining the foundation underneath it. Think about what's actually holding this system together. It's not productivity growth. It's not savings. It's not real wealth creation. It's debt, massive, expanding, and increasingly unpayable debt. Governments are borrowing at levels that would have been considered reckless just a couple of decades ago, and central banks are enabling it by keeping interest rates artificially low whenever the system shows signs of stress. When rates do rise, it's not because the system is strong enough to handle them. It's because inflation has forced their hand. And even then, they can't keep rates high for long without exposing just how fragile everything really is. So what you're seeing isn't strength, it's a balancing act. A carefully managed illusion where every problem is temporarily solved by creating a bigger one. Markets go down, inject liquidity, debt becomes too expensive, lower rates. Currency loses purchasing power, redefine the metrics, change the narrative, and tell people inflation is under control. It's a cycle of intervention that gives the impression of control while steadily eroding confidence in the system itself. The real issue is that fiat currencies derive their value from trust, not from anything tangible. There's no anchor, no constraint, just confidence, and confidence can be managed until it can't. Right now, that confidence is being maintained through messaging and short-term policy tools. Strong currency headlines, selective economic data, and a constant reassurance that everything is better than expected. But ask yourself, better than expected compared to what? Expectations have been lowered so much that even weak data gets spun as positive. Meanwhile, the structural problems keep getting worse. Deficits are growing, not shrinking. Debt servicing costs are rising, not falling. And instead of addressing these issues directly, the strategy has been to inflate them away slowly while pretending that inflation itself is under control. That's the contradiction at the heart of this illusion. You can't simultaneously rely on inflation to reduce the real burden of debt and convince people that inflation isn't a problem. At some point, that narrative breaks, and when it does, the perception of strength disappears very quickly. Because what people think is stability is actually dependency. Markets are dependent on low rates. Governments are dependent on continuous borrowing. Consumers are dependent on credit to maintain their standard of living. Remove or even weaken any of those supports, and the whole structure starts to shake. What makes this particularly dangerous is how convincing the illusion can be in the short term. A rising stock market is interpreted as economic health. A stable or strengthening currency is seen as proof of sound policy, but these are symptoms of intervention, not indicators of genuine strength. They reflect where money is flowing, not why it's flowing there. When central banks expand liquidity, that money has to go somewhere, and it often ends up inflating asset prices, creating the appearance of prosperity. But asset inflation is not the same as wealth creation. It doesn't increase productivity. It doesn't improve fundamentals. It just redistributes value and amplifies risk. And yet it's used as evidence that the system is working. That's part of the illusion, confusing price movements with economic reality. At the same time, the purchasing power of money continues to erode. It may not always show up immediately in official data, but people feel it. The cost of living rises, savings lose value, and the gap between perception and reality widens. Still, the narrative persists. The system is strong, the currency is stable, and any concerns are overblown. But stability that depends on constant intervention isn't stability at all. It's maintenance. It requires continuous input to sustain itself. And the more it's maintained, the more fragile it becomes, because it never has the chance to correct naturally. Imbalances aren't resolved, they're extended. Risks aren't reduced, they're shifted. Eventually, the cost of maintaining the illusion becomes too high. Either inflation accelerates beyond what can be managed, or the system tightens to a point where the underlying weaknesses are exposed. In either case, the perceived strength of the currency and the broader financial system is called into question. And when that happens, the shift in sentiment can be sudden and severe, because once confidence starts to break, it doesn't decline gradually, it cascades. The same factors that were used to support the illusion, liquidity, messaging, policy intervention, lose their effectiveness. And what's left is the reality that was always there, just hidden beneath layers of temporary stability. So when you hear that everything is strong, that the system is sound, that the currency is solid, understand what you're really being told. You're being told that the illusion is still intact, not that the fundamentals have improved, not that the risks have been eliminated, but that for now, the perception of strength is being successfully maintained. If you're trying to understand why gold and silver haven't already exploded higher, given everything happening in the global economy, you're asking the right question, but you're probably not being given an honest answer. Because what you're looking at isn't a free, transparent market behaving purely on fundamentals. What you're looking at is a pricing mechanism that's heavily influenced by forces with a vested interest in keeping those prices under control. Gold and silver don't just represent commodities. They represent competition to fiat currencies. They are, by their very nature, a referendum on monetary policy. When they rise sharply, send a signal, one, that policymakers would rather not have amplified, that something is wrong with the currency, that inflation is a problem, that confidence is slipping. So there is a clear incentive to manage that signal, to dampen it, to keep it from becoming too loud or too obvious. One of the primary ways this is done is through the paper market. The vast majority of gold and silver trading doesn't involve physical metal changing hands. It happens through futures contracts, options, and other derivatives, essentially promises to deliver metal that may or may not exist in sufficient quantity. This creates a situation where supply can be expanded almost infinitely on paper, regardless of the actual physical availability. And when you can increase supply like that, you can influence price. So what happens is you get these large, sudden sell-offs in the paper market, massive volumes hitting the market in very short periods of time, often during thin trading hours when liquidity is low. These aren't rational profit maximizing trades. They're not designed to get the best price for the seller. They're designed to move the market, to push prices down quickly, trigger stop loss orders, and create a cascade of selling that reinforces the move. Then the narrative kicks in. Prices fall, and the explanation is conveniently aligned with whatever policy goal is being promoted at the time. Maybe it's strong economic data. Maybe it's rising interest rates. Maybe it's a stronger currency. The story is always that gold and silver are falling for fundamental reasons. Even when the timing and scale of the move suggest otherwise, at the same time, there's a consistent effort to shape expectations. Investors are told that gold is outdated, that it yields nothing, that it's not necessary in a modern financial system. They're encouraged to view it as a relic rather than a hedge. And when prices are suppressed or stagnant, that narrative appears to be validated. People start to believe that maybe gold and silver just aren't that important anymore, but that's part of the strategy. Because the less interest there is in physical metal, the easier it is to maintain control through the paper market. As long as most participants are trading derivatives instead of taking delivery, the system can function without being tested. It's only when demand for physical metal increases significantly, when people start asking for actual delivery instead of rolling over contracts, that the imbalance becomes a problem, and that imbalance is real. The amount of paper claims on gold and silver far exceeds the amount of physical metal available to satisfy those claims. That doesn't matter as long as confidence remains intact, as long as participants are willing to settle in cash or continue trading on paper. But it introduces a vulnerability, one that could be exposed if enough people decide they want the real thing. Another layer of this suppression comes from policy signaling. When central banks talk about tightening monetary policy, raising interest rates, or reducing inflation, it creates downward pressure on gold and silver, at least in perception, because the narrative is that higher rates strengthen the currency and reduce the need for a hedge. Whether or not those policies are sustainable is a different question, but the signaling itself influences behavior. So you end up with a coordinated effect, paper market activity influencing price in the short term and policy narrative shaping expectations in the longer term. Together, they create an environment where gold and silver appear weaker than they actually are, where their role as monetary alternatives is downplayed, and where investors are discouraged from taking them seriously. But suppression doesn't eliminate value, it distorts it. It creates a disconnect between price and fundamentals. And the longer that disconnect persists, the more significant the eventual correction is likely to be. Because underlying demand doesn't disappear, it builds quietly, steadily, often out of sight of the mainstream narrative. You can see it in central bank behavior, in physical buying trends, in the steady movement of metal from exchanges into private hands. These are not the actions of entities that believe gold and silver are irrelevant. They're the actions of participants who understand their role in a system that is becoming increasingly unstable. The key point here is that price is not always a reliable indicator of value, especially in a market where supply can be expanded synthetically and where large players have both the means and the motivation to influence outcomes. What looks like weakness can actually be the result of pressure. What looks like disinterest can be the result of discouragement. And for investors, that creates a trap. Because if you take the price at face value, if you accept the narrative that gold and silver are underperforming for legitimate reasons, you're likely to position yourself accordingly. You might reduce exposure, shift into other assets, or ignore the metals entirely. And that's exactly the outcome that this kind of environment tends to produce. But if you look beyond the surface, if you consider how the market is structured, who the major participants are, and what incentives are at play, you start to see a different picture. One where prices are not just discovered but influenced, one where the apparent calm is not a reflection of stability, but the result of ongoing intervention. And like any system that relies on intervention to maintain control, it carries the risk of losing that control, because suppression can delay a move, but it can't prevent it indefinitely. At some point, the forces that have been held down begin to assert themselves. And when they do, the adjustment tends to be rapid because the price has been artificially restrained for so long. So the question isn't whether gold and silver should be higher based on fundamentals. The question is how long the current structure can continue to keep them from reflecting those fundamentals, and what happens when it no longer can. What makes this situation so effective isn't just policy or market structure or even price manipulation, it's psychology. Because in the end, markets don't just move on fundamentals, they move on perception. And if you can shape how investors think, how they feel, and how they interpret what they see, you don't need to control every outcome directly. You just need to guide behavior in a way that produces the result you want. That's exactly what's happening. Investors are being conditioned step by step to lose confidence in gold and silver at precisely the wrong time, not through a single event, not through an obvious warning sign, but through a slow, consistent process of reinforcement. Prices don't perform the way people expect, narratives shift, and over time, the conviction that these metals are essential begins to erode. It starts with volatility. Short-term price swings create uncertainty. Gold goes up, then it drops. Silver spikes, then it pulls back sharply. Instead of seeing these moves as noise within a larger trend, investors start to question the entire premise. They begin to think maybe the story isn't as strong as they believed. Maybe the timing is wrong. Maybe there are better opportunities elsewhere. Then comes comparison. While gold and silver move sideways or struggle to gain momentum, other assets appear to thrive. Stocks rise, risk assets rally, headlines celebrate growth, innovation, and new highs. And investors naturally start to feel like they're missing out. Holding precious metals begins to feel like standing still while everything else moves forward. That feeling, fear of missing out, is one of the most powerful psychological forces in markets. It pushes people to abandon long-term strategies in favor of short-term performance. It makes them question decisions that were originally based on sound reasoning, and it creates a subtle pressure to conform, to follow the crowd, to be where the action is. At the same time, there's a steady stream of messaging reinforcing the idea that gold and silver are no longer relevant. You hear that they don't generate income, that they underperform in strong economies, that modern financial systems have evolved beyond the need for hard assets. These arguments are repeated often enough and in enough places that they start to feel like common sense. But repetition doesn't make something true, it just makes it familiar. And familiarity can be mistaken for validity. So investors find themselves caught between what they originally believed and what they're now being told. They see prices not behaving as expected. They hear narratives that contradict their thesis, and they feel the pull of other opportunities that seem more rewarding in the moment. That tension creates doubt. And doubt is where the trap really takes hold, because once doubt sets in, decisions change. Investors start to second guess their positions. They reduce exposure, not because the fundamentals have changed, but because their confidence has. They wait for, that often comes too late. Or they exit entirely, convincing themselves that they can always come back later when the trend is clearer, but markets don't reward that kind of hesitation. The biggest moves tend to happen when the fewest people are positioned for them. And by the time confirmation arrives, much of the opportunity has already passed. Another layer to this psychological trap is the focus on short-term data. Every economic report, every policy announcement, every price movement is analyzed in isolation. Investors react to each piece of information as if it defines the entire outlook. Strong jobs report, gold should fall. Rate hike, silver should struggle. Currency strength, metals are out of favor. This kind of thinking reduces a complex long-term macro environment into a series of short-term reactions. It shifts attention away from the broader structural issues, depth, monetary policy, currency stability, and onto temporary signals that may or may not have lasting significance. And because those short-term signals often contradict each other, they create confusion. One week supports the bullish case for metals, the next week undermines it. Investors are pulled in different directions, never quite certain which narrative to trust. That uncertainty leads to inaction, or worse, to reactive decision-making. There's also the issue of time horizon. Gold and silver are not short-term trades in the traditional sense. They're strategic positions, often tied to long-term views on currency, inflation, and systemic risk. But in a market environment dominated by instant feedback and rapid price movements, patience becomes difficult. Investors expect quick results. When they don't get them, they assume something is wrong. They forget that the very reason to hold these assets is to hedge against outcomes that haven't fully materialized yet. And so they judge long-term positions based on short-term performance, which is almost guaranteed to lead to disappointment. What makes all of this so effective is that it doesn't feel like a trap while you're in it. It feels like rational decision-making. It feels like adapting to new information, responding to market conditions, staying flexible. But in reality, it's a process of being gradually steered away from a position that becomes most valuable when it's least popular. And by the time the shift becomes obvious, when the underlying issues can no longer be ignored, when the narrative changes, when prices start to move decisively, most investors are no longer in place to benefit. They've already been shaken out, worn down by volatility, convinced by narratives, or distracted by other opportunities. So the trap isn't just about getting the direction wrong. It's about getting the timing wrong. It's about being right in theory, but wrong in execution because your conviction didn't survive the journey. That's the real challenge. Not identifying the long-term case, but maintaining the discipline to hold it in an environment designed to make you question it at every step, because the forces at play aren't just economic, they're behavioral. And unless you recognize how those forces are influencing your decisions, you're likely to respond in ways that serve the system rather than your own interests. In the end, the psychological trap works because it aligns external signals with internal reactions. It creates a feedback loop where price action reinforces narrative, narrative reinforces emotion, and emotion drives behavior. And once that loop is established, it becomes very difficult to break out of it unless you step back and see it for what it is. At some point, the gap between perception and reality closes. It always does. You can stretch it, you can manage it, you can delay it, but you can't eliminate it. And that's where this is all heading, because the current pricing of gold and silver doesn't reflect the underlying risks in the system. It reflects confidence in a system that is becoming increasingly difficult to justify. Right now, everything is built on the assumption that policymakers can maintain control indefinitely, that they can manage inflation, support growth, stabilize markets, and sustain confidence in fiat currencies all at the same time. But those objectives don't always align. In fact, they often conflict, and the more aggressively you try to achieve one, the more you undermine another. Take inflation, for example. The official narrative may suggest it's under control, that it's temporary, that it's moving in the right direction. But look beneath the surface and you see persistent pressures, rising costs, expanding money supply, structural imbalances that haven't been resolved. These aren't conditions that disappear easily. They're conditions that build over time. Now consider the response. To combat inflation, you need tighter monetary policy, higher interest rates, reduced liquidity, less borrowing, but that creates stress elsewhere in the system. It increases the cost of servicing debt, puts pressure on financial markets, slows economic activity, and in a system that is already heavily dependent on cheap money, that kind of tightening can't be sustained for long without consequences. So you end up in a position where every solution creates a new problem. Tighten too much and you risk a financial crisis. Ease too much and you fuel inflation. Try to balance both and you achieve neither effectively. That's the constraint. That's the reality behind the illusion of control. And this is where the repricing comes in, because gold and silver are not just commodities, they're alternatives. They represent a different form of money, one that isn't tied to policy decisions or dependent on confidence in institutions. When confidence in fiat systems is high, that alternative is less attractive. But when confidence starts to erode, the dynamic changes. At first, it's subtle, small shifts in allocation, a bit more interest in physical metal, a gradual increase in demand that doesn't immediately show up in price. But over time, as the underlying issues become more visible, those shifts accelerate. What starts as a trickle becomes a flow, and then something triggers a broader realization. It could be a policy mistake. It could be a sudden spike in inflation. It could be a loss of confidence in a major currency or a disruption in financial markets. The specific catalyst is hard to predict, but the conditions for it are already in place. When that trigger hits, the repricing doesn't happen slowly. It happens quickly because the market has been misaligned for so long. Prices that were held down by confidence and intervention suddenly have to adjust to reflect a new reality, and that adjustment is not incremental, it's abrupt. Investors who previously ignored gold and silver begin to take notice. Those who are underweight rush to increase exposure. Those who dismiss the metals as irrelevant start to reconsider. And because the supply of physical metal is limited, especially relative to the volume of paper claims, the price response can be disproportionate. This is where the concept of repricing becomes important. It's not just about prices going up. It's about a fundamental shift in how these assets are valued. A move from being seen as optional to being seen as essential, from being a hedge to being a necessity. And that shift has implications beyond just the metals themselves. It reflects a broader loss of confidence in the system that priced them so low to begin with. Because if gold and silver are rising dramatically, it's not happening in isolation. It's happening in response to something else deteriorating. That's why the timing is so difficult, because the system can appear stable right up until the moment it isn't. The same policies that create the illusion of control can suppress the signals that would otherwise warn of a problem. And by the time those signals become wavish, the adjustment is already underway. What makes this even more significant is how underprepared most investors are for it. After years of being told that gold and silver are outdated, after experiencing long periods of underperformance or stagnation, many have reduced or eliminated their exposure. They've been conditioned to look elsewhere, to prioritize assets that perform well in the current environment. So when the environment changes, they're not positioned for it. They're forced to react rather than benefit. And in a rapidly moving market, that kind of reactive behavior tends to be costly. Meanwhile, those who maintain their positions, who understood the long-term dynamics and were willing to endure the short-term noise, find themselves in a very different situation, not because they predicted the exact timing, but because they recognized the inevitability of the outcome, because that's really what this comes down to, not prediction, but probability. When you have a system built on expanding debt, reliant on continuous intervention, and constrained by conflicting objectives, the range of possible outcomes narrows over time. And within that range, certain outcomes become more likely than others. A significant repricing of gold and silver is one of those outcomes. Not because it's guaranteed to happen on a specific timeline, but because the conditions that would justify it are already present and becoming more pronounced. The longer those conditions persist without being resolved, the greater the imbalance becomes. And the greater the imbalance, the more dramatic the eventual correction is likely to be. So the question isn't whether the current pricing accurately reflects reality. It doesn't. The question is how long that disconnect can continue and what happens when it ends, because when it does, the shift won't be subtle, it won't be gradual, it will be a recognition all at once that the assumptions underpinning the system were flawed. And in that moment, assets that were overlooked, dismissed, or deliberately suppressed will be forced to adjust, not to where they were, but to where they should have been all along.